RKMVERIFRE content for EC 101 Central Bank and its policy measures. Presented by Mr. B. Mutharaja, Assistant Professor, Agricultural Economics. Classroom conversation about RBI's recent monetary policy and bank rates. Participants, teacher and his student.
Good morning. Good morning. I want to discuss about recent RBI's monetary policy. I have heard recently that Governor of Reserve Bank has reduced repo rate by 50 basis points, and everyone is saying that this is good for the market. Bank loan EMIs may also come down. What is this rate cut means actually? I want to understand this. To understand this, you first need to know, how does a bank function? Why? Because all these are interrelated. Tell me, what does a bank do? Bank takes money from depositors and gives loan to earn interest. That way, they keep everyone happy and make a profit also. Correct, but there are more to it. Let me explain this in a very simplistic way. Bank needs money. Bank can get money from depositors like you and me, and also from RBI. But bank also needs to pay certain interest to us and also to RBI. Okay, let us try to understand first what happens when we deposit, say, rupees 100 with a bank. I think the bank gives that rupees 100 to someone who needs a loan. No, it is not that simple. Remember, the bank can earn interest by giving away loans, but it is also very risky. There are many cases of loan defaults. This way, banks can put all our money into high-risk areas. It has to be protected. How? RBI, as being chief monetary authority, made it mandatory that, upon receiving, say, rupees 100, the banks first have to deposit rupees 3 with RBI. And RBI keeps this rupees 3 in its current account, and hence, banks do not receive any interest on this money. This is known as cash reserve ratio, or CRR, which is currently at 3%. Oh, then? RBI has also made it mandatory that, upon receiving, say, rupees 100, banks need to compulsorily buy central and state government securities of rupees 18. Of course, banks will earn some interest income here. This is known as Statutory Liquidity Ratio, SLR, which is currently at 18%. So, it means that, upon receiving rupees 100, banks can only spend rupees 79 at its own will. Correct. 100 minus 3 plus 18 equals 100 minus 21 equals 79. But you were saying that banks can also borrow from RBI. What interest banks pay to RBI? Banks were paying 4% interest to RBI when it borrows money from RBI. This is known as repo rate. Can fixed deposit rate be affected by reduction of repo rate? Of course. If banks get money from RBI at 4%, why will banks pay higher interest to you and me? 1-year bank rate is already revised by many banks, and it is equal to, or very close to 4%. But, as now banks are getting money at a cheaper rate, then they should reduce the loan interest rate that is passing on the benefits it receives. Correct. They should. And on that hope market is cheering. If companies get loan at a cheaper rate, they will likely to expand their businesses. That will create more jobs, more income, and boost the economy. It is good news to hear, Professor. And I want to know, how is inflation linked to this? When loan becomes cheaper, people tend to borrow more. That means, people will have more money to spend. This will increase the demand for goods, and, if supply does not increase to match this demand, then prices will increase. So there is a chance that inflation may rise also? Well, yes. But inflation depends on many other factors as well, like industrial and agricultural production, export-import, foreign currency movement, etc. So, inflation may increase or may not. I have one last question. Like we deposit our money with banks, can banks also deposit their money with someone? Yes, they can deposit with RBI and earn interest too. This interest is typically less than the repo rate, 3.35%. This rate is known as reverse repo rate. Great! So now I understand CRR, SLR, repo rate, reverse repo rate and their impact on deposit rate, loan interest rate and on inflation. Thank you. Good.